welcome to Economy and Markets TV, the show that takes you around the world of economic and financial news. I'm your host, Dave Oakenquist, Senior Research Analyst here at Dent. Today I'm bringing on Rodney Johnson. Rodney is obviously the co-founder and senior editor of Dent Research. Rodney, welcome once again.
Thank you, Dave.
Thank you also for joining me on such short notice. I rung Rodney and said, hey, we got something going on. I think we need to talk about it. There's an indicator that's been getting a lot of attention in the news. It's really just about what's going on with the economy. It's this flattening yield curve. Is it flashing a warning sign for a recession? I'm sure you've come across this as well, Rodney. What are your thoughts on this?
Yeah, I was a bond trader in my former life, and so kind of lived and died by interest rates. And so this is something we talked about all the time.
Right.
Flattening yield curve is, the curve is yields on short maturities being overnight rates, which you get paid on your deposits on savings accounts, things like that, things the Fed sets up to the 30-year bond. And it tends to go in this nice arc or a curve. But when the long bonds start yielding closer to the short bonds, that's kind of weird, right? Why would you get paid the same amount to deposit money, say, overnight as you would for 5-6 years, or the same at 10 years as you would for 30? And so it comes down to the government, being the Federal Reserve, controls short-term interest rates. They set that rate, and they just moved it, as we know, 1.75 to 2%.
Yep.
But the market, being bond buyers and sellers, set the long rate, what we think is going to happen. And that tends to go by what we see as growth in the economy and inflation. And so if we see more growth, we see more inflation, then we demand higher yields for putting money away longer. Makes sense, right?
Absolutely.
And so the idea is when long bond buyers, institutions, individuals, insurance companies, whatever, see less growth or see falling inflation, typically meaning tough times in the economy or a recession, that they will buy bonds, which pushes up the price of long bonds and pushes down the yield and makes that yield come closer to what it is on the short end. Okay. And when the long yield actually goes under the short overnight rate, then the yield curve is inverted. It's upside down. That's what people are talking about.
How often does that happen?
Well, that's just it. It doesn't happen very often. It tends to happen right in front of a real recession.
Okay.
And this is one of those things where people say the bond market is smarter than the equity markets because you have a lot of people who are going, hey, wait a second, I see some trouble ahead. I'm going to put more money into bonds, and I'm willing to accept a much lower interest rate so I can hide over there in bonds while we kind of work out what's going on in the economy. And equities tend to fall during the recession. Okay. And so it's been a very good indicator of tough economic times. But here's the problem. We're not in normal times. It has become, as you and I have discussed way too many times, an old story that the Federal Reserve bought $4.5 trillion worth of bonds.
Right.
That's just here at home. Central banks around the world added $15 trillion since the downturn, and what most of them bought were bonds. And so they were pushing down yields, not because they see any trouble ahead. They're trying to keep people borrowing by making interest rates very low. And so this weird skew of the market changed this number. And so we really can't learn anything from where we are right now in terms of the yield curve, because while we have the Federal Reserve actually shrinking its balance sheet a little bit and not buying more bonds, we have other areas like the economic bloc in the EU continuing to spend $30 billion a month on bonds. We have the Chinese who intervene, the Japanese intervene. And so it's not just us. We have to look at central banks around the world and understand this is not telling us what it has before, because we have these players artificially pushing down yields and pushing up prices.
Right. Okay. So central banks have jacked things up so much that it's just really hard to use these traditional indicators. Right. Try to get a beat on what's going to happen. A source we always, if you could find out when the recession's coming, that would be really valuable. So if that's not a good indicator, what would be a good indicator?
Well, we have to go back to what we know, right? Recession is 2 quarters of declining GDP.
Right.
And so it makes sense that if you're going to look for that sort of information, you're going to look at some measure of GDP. And the thing that we found, you were working with us way back then, right? I think 2011 is when the Federal Reserve Bank in Atlanta came out with their GDP model, and we started watching it then, and it has been the most accurate measure of current GDP. And what makes their model so robust is that they update their forecast of GDP every time they get a meaningful piece of economic data.
Right.
And so, yeah, they had housing come in, existing home sales lower than expected last week. And so they lowered their GDP forecast accordingly. And because it responds to every one of these, you get a really good look at what's going on now, hence the name, right? GDP Now.
GDP Now.
And so that's the one we watch. We talk about it most every week when it changes.
Absolutely.
And so when that one rolls over, and right now it's at 4.5% for the second quarter, which is a big number. When it rolls over and starts trending lower, that's when people should be paying attention and saying, hey, wait a second, we really have some things going on here we have to watch. Perhaps there are some rough times coming.
Yeah, absolutely. So you say 4.5%. What we see typically is that this number, it bounces around during the quarter, but it tends to land fairly close to the GDP print. We are at June 27th today. The quarter ends in just a couple of days here. We're going to get another update on Friday. I don't anticipate it moving very much. So the idea you have this is a yield curve telling you recession, or is the GDP now saying 4.5%, which has been more accurate. And if we can't pay attention to these things because central banks have queered the market so much, then I think I know where I'm going to be looking.
Well, and let's get back to the yield curve for just a second, then we'll go back to the GDP now. And the yield curve, understand what's gone on. The long bond in the United States, the 30-year bond, has been around 3% for quite some time.
Yeah.
But while that long bond has stayed at 3%, the overnight rate that is set by the Fed has moved higher. So the overnight rate has come up to the long bond. It's not as if long bonds have come down to the overnight rate. Mm-hmm. And so that's something else telling you, hey, wait a second, you got a lot of weird things going on here. It's not as useful as it was in the past. Mm-hmm. And as for GDP Now, we continue to get data on the second quarter through the next, or any quarter actually, through the end of the quarter. And so the quarter ends on June 30th, obviously, but we'll get reports for what happened in June during the month of July.
Right.
And so we won't get our first estimate of second quarter GDP until the fourth week of July, fourth Friday, I believe. But we'll continue to get updates on GDP Now from the Atlanta Fed during the first few weeks of July. And so, as you say, right now they're 4.5. Well, if we had a slowdown in economic activity during June, the Atlanta Fed will then update their model in the first couple of weeks of July so that they can get closer and closer. And so if people want to, they could certainly go look at the Atlanta Fed's website, check out that GDP Now model, and they can watch it and see in real time what's going on.
Yeah, absolutely. Rodney, thank you so much for joining me. Thanks for clarifying all of that for me and the audience. And again, thanks for joining me on short notice. I hope you're all enjoying these videos. We'll catch you again soon.